If you observe carefully the Federal Reserve's movements over the past few years, you'll see a pattern that repeats throughout history. The systematic degradation of the national currency in the name of short-term economic stability. This isn't a conspiracy theory. It's a logical consequence of a system that prioritizes immediate relief over long-term financial discipline. When an economy accumulates debts it cannot pay, when the government consistently spends more than it collects, when productivity cycles cannot keep pace with the growth of financial obligations, only one historically proven exit remains: currency devaluation. What we're witnessing today in the United States is not new. It's the same script we saw in ancient Rome, in Weimar Germany, in post-World War II Britain, and in dozens of other empires throughout history. The difference is that this time you have the opportunity to understand the process before it completes. And with that understanding, you can protect and even amplify your wealth during this inevitable transition. This is not a moment for panic. It's a moment for clarity, preparation, and action based on timeless principles that govern all economic cycles. History is an excellent teacher, and it teaches us that all world reserve currencies eventually lose that status. The US dollar has held this position for approximately 80 years, long enough that most people alive today have never experienced such a transition, but these transitions are as natural as the seasons. Let's observe the pattern. A nation emerges with superior productive force, technological innovation, and fiscal discipline. Its currency gradually becomes the globally preferred medium of exchange. The country enjoys the exorbitant privileges of having its currency universally accepted. It can print money to buy real goods from other countries. Initially, this privilege is used with moderation, but over time, the temptation becomes irresistible. Why suffer through recessions when you can simply print more money? Why implement painful reforms when you can postpone problems indefinitely? This is exactly how the British Empire lost the sterling's hegemony to the US dollar between 1914 and 1944. London financed two world wars by printing money, accumulated unsustainable debts, and saw its currency lose international credibility. Before the British, it was the Dutch with the florin. Before the Dutch, it was the Spanish with a real de ocho, and so on, going back to the Roman Empire and its denarius. Each transition followed the same script: exponential debt increase, disconnection between real production and monetary creation, gradual loss of international confidence, and finally, the search for alternatives. If you understand the incentives, you understand the behavior. The Federal Reserve today faces pressures identical to those faced by all reserve currency central banks in the past, keeping the economy functioning in the short term, even if this compromises long-term monetary stability. To understand what's happening with the dollar, we need to examine the fundamental mechanisms that govern all currencies and economies. Every economic system depends on a delicate balance between two factors: the capacity to produce real goods and services, and the amount of money and credit circulating in the system. When productivity grows faster than the money supply, you have deflation, more goods chasing the same amount of money. When the money supply grows faster than productivity, you have inflation, more money chasing the same goods. The problem arises when an economy needs to grow its debt exponentially just to maintain basic functioning. This happens when government spending systematically exceeds revenues, when the private sector depends on increasing levels of debt to maintain consumption, and when productivity cannot keep pace with the growth of financial obligations. At this point, the central bank faces an impossible choice: allow a painful but necessary deflationary recession, or print money to postpone the problem. Historically, all central banks choose the second option, not because it's wiser, but because it's more politically viable. But there's something even more fundamental happening here. The economy functions in multiple simultaneous cycles. The short-term cycle lasting 5 to 10 years, is what most people perceive regular recessions and expansions. But there's a much longer cycle lasting between 50 to 100 years related to debt accumulation and deleveraging. This long cycle determines the fate of reserve currencies. We are currently at the end of a long cycle that began after World War II. The characteristics of this moment are unmistakable. Total system debt near or above GDP. Interest rates near zero, limiting the central bank's ability to stimulate the economy conventionally. Declining productivity growth while financial obligations continue growing, increasing social inequality and internal political tensions, and the emergence of rival powers with alternative monetary systems. These conditions create an environment where money printing becomes not just probable, but inevitable. And here we reach the most crucial point. A currency is fundamentally a social contract based on trust. People accept colored papers or electronic digits in exchange for real goods because they trust others will do the same in the future. This trust depends on two critical factors: stability of purchasing power over time and credibility of the institutions that control the currency. When a central bank consistently prints money to solve fiscal problems, it erodes both factors. Purchasing power diminishes through inflation, and institutional credibility deteriorates through the perception that monetary policy is subordinated to fiscal policy. The process doesn't happen overnight. It can take decades. But once initiated, it's extremely difficult to reverse because it requires a political discipline that rarely exists in modern democracies. Let me show you how these principles have manifested in practice throughout history. Imagine a nation devastated by war, burdened with impossible reparations to pay, facing military occupation and political instability. The German government faced a choice: implement brutal austerity or print money to meet obligations. It chose the second option. Initially, the strategy seemed to work. Unemployment decreased, industrial production recovered, and the government managed to pay its bills. But Germans who understood the fundamental principles began converting marks into real assets: real estate, stocks, commodities, foreign currencies. In 1918, $1 bought 4 German marks. In 1923, it bought 4.2 trillion marks. Germans who kept their savings in marks lost everything. Those who diversified into real assets preserved and even amplified their wealth. The United Kingdom faced similar pressures during both world wars. To finance the war efforts, the Bank of England dramatically expanded the money supply and accumulated enormous debts. After 1944, London tried to maintain the pound's international status through the Bretton Woods system, which pegged other currencies to the dollar and the dollar to gold. But internal pressures were unsustainable. Smart Britons began diversifying into US dollars, gold, and international assets as early as the 1952nd. When the pound finally lost its reserve currency status, they were protected. Now, the United States today faces pressures structurally identical to those faced by all previous empires. Federal debt of $33 trillion growing by $1 trillion per year, structural fiscal deficits requiring constant financing, unfunded obligations like Medicare and Social Security estimated at over $100 trillion, and interest rates that cannot rise significantly without making the debt unpayable. Simultaneously, alternatives to the dollar system are emerging. China and Russia developing independent payment systems, OPEC countries accepting other currencies for oil, growth of digital currencies and decentralized payment systems, and increased gold reserves by global central banks. If you understand the incentives, you understand that the Federal Reserve will choose to print money instead of allowing devastating deflation, not because it wants to weaken the dollar, but because the alternatives are politically impossible. As a prudent American observing these historical patterns, you should ask yourself, what can I do to protect my wealth during this inevitable transition? The answer isn't in panic or speculation, but in applying timeless wealth preservation principles that have worked in all monetary transitions in history. If you're between 40 and 80 years old, your retirement will be directly affected by the dollar's weakening. Consider the numbers. A retirement that today requires $1 million may need 2 to 3 million in 20 years if real inflation is 4 to 6% annually. Investments in government bonds, traditionally considered safe, may lose real purchasing power even while paying positive nominal interest. Pensions and government benefits will maintain their nominal values but lose real purchasing power. The stock market may seem like a refuge, but not all stocks behave equally during inflationary periods. Companies with high pricing power, substantial physical assets, little debt, and cash flows in diversified currencies historically outperform companies with opposite characteristics. Even if your investments adapt to inflation, your daily life will be affected. Prices of food and energy tend to rise faster than general inflation. Health services, education, and housing become proportionally more expensive, and imported goods become more expensive as the dollar weakens internationally. Based on the principles that govern all monetary transitions, there are specific strategies you can implement to protect and potentially amplify your wealth during this period. The first fundamental principle is not to keep 100% of your assets in dollars. Currency diversification doesn't mean speculating in Forex, but rather owning assets denominated in multiple stable currencies. Practical options include stocks of multinational companies that generate revenues in multiple currencies, international investment funds that naturally diversify currency exposure, real estate in countries with historically stable currencies, and bonds from governments with responsible fiscal histories. The second essential principle is understanding that during currency devaluation periods, real assets, which represent ownership of physical things, historically outperform financial assets, which represent promises of future payment. Effective real assets include productive real estate that generates income in demographically favorable locations, stocks of companies with substantial physical assets like mining, oil, agriculture, and utilities, physical commodities like gold, silver, and industrial metals, and agricultural land in regions with abundant water resources. The third principle is focusing on productive investments. The best protection against currency devaluation is investments that increase your personal productive capacity or participate in the real productive growth of the economy. This means education and skills that maintain relevance during technological changes, participation in companies that create real value and don't just manipulate money, investments in technologies that increase human productivity, and social and professional networks that open opportunities independent of specific currency. The fourth principle is preparing for volatility. Monetary transitions don't happen smoothly. They involve periods of high volatility where extraordinary opportunities emerge for prepared investors. Practical preparation means maintaining sufficient liquidity to take advantage of opportunities during crises, avoiding excessive leverage that can force sales at inopportune moments, developing multiple income sources independent of a single employer or region, and creating emergency reserves in multiple forms. The fifth principle is geographical positioning. Just like diversifying currencies, geographical diversification reduces systemic risk specific to one country or region. Options include properties in multiple politically stable countries, bank accounts and investments in jurisdictions with stability records, alternative citizenship or residence in countries with sound economic systems, and international commercial and personal relationships. Now, specific strategies vary depending on your age and situation. For people between 40 and 50 years old, you have enough time to implement changes gradually and benefit from complete appreciation cycles. Focus on building multiple income sources, investing heavily in financial education and relevant skills, establishing positions in real assets that appreciate with inflation, and developing international personal and professional networks. For people between 50 and 65 years old, you're in the critical phase of pre-retirement wealth accumulation. Prioritize accelerating retirement contributions through diversified vehicles. gradually reducing exposure to traditional fixed income assets, increasing positions in stocks of companies with pricing power, and considering commercial or residential real estate for income. For people between 65 and 80 years old, you need stable income, but also inflation protection. Strategies include REITs that adjust rents with inflation, dividend champion stocks, companies that consistently increase dividends, treasury inflation protected securities as an anchor but not as a majority position, and maintaining liquidity for opportunities during market volatility. Understanding psychology is as important as understanding economics during periods of monetary change. Most people assume the future will be similar to the recent past. Americans who have lived only under dollar hegemony have difficulty imagining alternatives. This bias can be dangerous. Prepare mentally for changes that seem unlikely but are historically normal. Many investors know changes are coming, but try to time perfectly when to implement protections. History teaches that it's better to be early by years than late by months. Position yourself gradually, not speculatively. Avoid both blind optimism and paralyzing pessimism. The American monetary system will change, but this doesn't mean civilizational collapse. Monetary changes are transitions, not endings. Prepare to take advantage of opportunities, not just avoid risks. Periods of monetary change, despite being challenging, create some of the greatest wealth creation opportunities in history. During monetary confidence crises, fundamentally sound assets are often sold indiscriminately. Prepared investors with liquidity can acquire productive companies at low multiples, real estate in prime locations at reduced prices, and commodities during temporary selling panics. Monetary transitions accelerate innovation in payment systems and value storage. Emerging technologies include decentralized payment systems, central bank digital currencies, new forms of property certification and transfer, and platforms that facilitate international diversification. Monetary changes create demand for new services, wealth protection, consulting, international diversification services, financial products adapted to the new reality, and technologies that increase efficiency during inflationary periods. To adjust your strategies as the situation evolves, monitor these key indicators. Signs of accelerating devaluation include dramatic increase in money creation speed, accelerated loss of dollar participation in international reserves, implementation of capital controls or monetary regulations, and significant increase in official inflation or goods shortages. Signs of temporary stabilization include substantive fiscal reforms that reduce structural deficits, significant increases in real interest rates, productivity improvements that support growth without inflation, and international agreements that renew confidence in the dollar system. Signs of opportunity include indiscriminate sales of quality assets during panics, emergence of promising new technologies or markets, regulatory changes that favor wealth diversification, and geopolitical developments that create information asymmetries. During monetary transitions, certain errors consistently repeat among unprepared investors. Don't concentrate all your bets on gold, Bitcoin, real estate, or any single asset. Diversification is fundamental during periods of uncertainty. During inflation, assets that generate growing income are superior to assets that depend only on appreciation. Prioritize productive investments. Monetary transitions take decades, not years. Position yourself for the long term, but maintain flexibility for adjustments. Fear and greed are especially destructive during volatile periods. Maintain discipline based on principles, not feelings. International diversification and ownership of alternative assets have complex legal and tax implications. Consult qualified professionals. Protecting wealth goes beyond investments. It includes preparing your family to navigate substantial economic changes. Teach basic economic and investment principles to spouses and adult children. During transitions, knowledge is as valuable as capital. Develop plans for multiple scenarios: moderate inflation, hyperinflation, deflation, political instability. Flexibility is crucial. Build relationships with people who share your understanding of the economic situation. During crises, Social networks are fundamental. Encourage family to develop skills that maintain value independent of the monetary system. Medicine, engineering, agriculture, craftsmanship. When we observe the great movements of history, we see that monetary changes are not catastrophes, but natural transitions in human development. Just as seasons inevitably follow each other, economic empires grow, mature, and give way to new systems. What makes this transition unique is not its inevitability that has always existed, but its predictability. For the first time in history, we have sufficient data about previous transitions to anticipate patterns and prepare adequately. This preparation doesn't require pessimism about the American future. The United States will continue to be a prosperous and influential nation, just as the United Kingdom remained prosperous after losing the pound's hegemony. But the dollar's special role as the world's reserve currency will gradually diminish, and with it, certain advantages Americans consider guaranteed. If you understand the incentives, you understand that this change is a logical consequence of economic and political forces larger than any individual or institution. It's not something to be lamented, but something to be understood and wisely managed. Real wealth, human productivity, natural resources, knowledge, relationships doesn't disappear during monetary transitions. It simply changes form and redistribution. Those who understand the underlying principles can not only preserve their wealth, but position it to prosper during change. History teaches us that great transitions are simultaneously moments of greatest risk and greatest opportunity. The difference between the two is preparation based on solid principles, not on hopes or fears. Your wealth, your family, and your future deserve this preparation. The knowledge is available. The patterns are clear. The tools exist. The only remaining question is, will you have the wisdom to act based on what history has already taught, or will you try to navigate this transition through hopes that this time will be different? As history consistently demonstrates, it's never different. But for those who understand eternal principles, this isn't a limitation, it's an invaluable advantage.